again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is the last trading day of February. It's February 28th. It's a Tuesday of 2023. Thanks for watching. Let's go through the three topics of the day that we're paying attention to as they are moving markets, and you should be too. So let's get right to it. Yesterday and today, we are seeing the 10-year Treasury move higher, close to the 4% mark, which we haven't seen that in quite some time. And that's important because as yields move higher, they're the forward-leading indicator as to what the Federal Reserve is potentially going to do. And we already know they have to raise rates in March and a few other times later this year. So we expect 3 interest rate rise or increases for 2023. The real question is the March meeting going to front load like they did last year, year over year at this time, the Federal Reserve that is? Meaning, do they go 50 basis points or 25? Now, your guess is as good as mine. Is about 27% chance based upon Fed funds futures pricing it in the market right now. But regardless of any of that conjecture or guessing or forecasting, the reality is that higher interest rates are going to impact the consumer and corporations. And so it's slowing the economy. So the brakes and the monetary policy, the easy monetary policy is continuing to wane. And it's not a question of how high will we go with interest rates. I think the debate now needs to transition to how long? How long will the interest rates be at the levels that we're going to see? And you're going to see them later in my conversation today. Different areas of the economy, specifically housing, and what the impact and the lag effect is actually taking hold. But again, from CNBC today, the 10-year Treasury yield hits the highest level since November, as we just discussed. And let's go to basically Treasury yields right now. And U.S. Treasury yields, if you look at the 1 month, you're at a 4.59%. So if you put your money in a U.S. Treasury, basically a zero coupon at this point, you're still going to get an annualized 4.9% if you were to keep it and roll it for the entire sort of 12-month period of time. But what's really interesting right now is the 6-month, and we at Blanke Schein Wealth Management for our clients have been doing a lot of buying treasuries. And whether it's the 6-month, 3, 6, 9, 12 months out, depending upon what the scale is relative to the client's respective need for liquidity. Again, U.S. Treasuries are completely liquid. We can sell them. There's always a daily market. And you're also going to get some tax benefits in terms of the yield as well. But you're looking at well over a 5% for a 6-month Treasury. Now, if you're uncertain or if you bank cash to put to work, that's what we've been doing for our clients because banks are basically about half of what you're going to see. And actually, banks are going to lock you in for about 2 to 3% for 2 years. Why would you do that when you could get a 1 year at even 5%, 5.029? So this is the really an attractive sort of sweet spot of the yield curve right now on the short term. If you don't know, you don't want to commit additional capital to the equity market right now, and you just want to put it in a place where you're going to earn a heck of a lot more than what you would see again at the bank or even in money markets. And then if something as markets present themselves with higher volatility and sort of just as markets do, they present opportunities for us. We then rebalance, take it out of treasuries and jump on opportunities that are down 10, 15, 20%. And that's how you basically manage the portfolio in a proactive way, as we do here for our clients at Blanke Schein Wealth Management. So this is another chart we're going to talk about, which is, this is historical data going from 1900s, actually 1900 to 2022. And historically speaking, what this ultimately has done, this chart, and the point we're bringing up today, is the real equity, real stock, and bond returns versus inflation. Let me do this here. Inflation rates in the real economy. So essentially, if you're looking at low economic growth or gross domestic product, now our GDP is shrinking, right? If it shrinks 2 quarters in a row consecutively, it's a technical recession. If you have a couple other factors, we are in a recession, if you will. So this is the camp that we're looking at right now as a slower growth environment because of higher interest rates, as we described. So if we're in the lower camp over here versus a midland economic growth environment, which we're not there, and we're definitely not at the high growth. So we're going to take this and talk about these two scenarios another day down the road, because we believe we're in this low, slow growth environment, economically speaking. Now, The dark blue are equities, the light blue are bonds, and it's the return relative to that inflationary environment, less growth, okay? So if we look at the first column here, higher inflation, and how that, if we have a slow growth or no growth, if you will, in the GDP, and we have high inflation, which we kind of saw over the last 12 months, if you will, both stocks and bonds essentially are down. Okay, it's a bad environment. Good environment to pick up opportunities, reposition the portfolio, upgrade the portfolio, as we've been doing, and rebalancing all of that. But I think the better news is right now we're transitioning from the higher inflation to mid to even potentially lower. And that remains to be seen how the net impact of Fed policy is into slowing the economy. But the good news here is both stocks and bonds perform well, historically speaking, under even a slow growth, even though the economy is slowing down, even though a potential recession, the stock and bond markets can tend to do better relative to those scenarios. And, if we get even moderate growth or even high growth, you could see the equity market is the place to be. But in all scenarios right now, we just passed this path right here over the last 12 months. So if you've endured this, there's potential for better returns ahead. I know I just drew all over this and made a mess, but I think you get my point here. Now let's go back to the last topic. I brought this up several times over the last couple of sort of weeks, as because U.S. housing and the question of housing slowing and home prices is just a daily debate. We're seeing sort of all of the different housing numbers come out and all of the National Association of Home Builders. And let's talk about this. These are the three charts I'm going to show you right now I had last week. So if you missed it, I'm going to represent it because I think it's very important as it relates to the housing story and the update that we're seeing. And essentially this is a chart right now, the U.S. home prices, and what we're seeing, right, a downtrend. And historically speaking, right now it's down 12% nationally. If you look at Zillow and some of the others, as the National Association of Realtors report. And that's one of the fastest declines that we've seen in recent history. And that's because interest rates and affordability. Interest rates have gone up, affordability has gone down. And so everyone's sort of pushing pause saying, hey, gosh, are we going to be at a 2007, 2008 scenario where, housing prices came down significant, 20, 30, 40%. And the reality is I don't believe that we're going to see that. We could see markets that have overbuilt, oversaturated. Like the San Francisco market is down around 12 to 15% right now, but then you have Atlanta and a few others like Tennessee and other markets where you're having actually home bidding in the month of January go up. So year over year, there's a net increase in terms of home valuations. So again, real estate is always local, right? And so it depends upon what market. Here in the Coachella Valley, we're seeing an uptrend or an increase in inquiries and homes going in escrow. Obviously, we saw some mortgage rates dip a little bit in the last few months. Now they're back up a little bit. But I think it just all depends on where you are relative to sort of the inventory. And that's really going to be the story moving forward. But, the question is, where do housing prices bottom out? It's all relative. We're going to see some homes, some markets, some areas do way better than others, relatively speaking, on the downside. But again, these are the two charts. The next two charts is what I really want to draw our attention to because they could give us some insight into housing. Clearly, affordability is an issue, right? So if interest rates go up, affordability goes down, and so that slows sort of the demand side of the equation. Less people in the market looking for homes. But this is not a demand issue. This is a structural issue in terms of supply. So post 2007, 2008, 2009, home builders stopped building, right? They had to recover and sort of hopefully just survive to the next housing sort of cycle. And we're seeing the housing cycle play out, but the home builders have had inventories that we haven't seen in decades. In fact, there's about 4 million homes that are needed over the next, several years just to keep up with the demand of, again, generationally, millennials, younger generations are now going from the affordability. Rents are going up in terms of just leasing a home or being in an apartment. And if you're looking at that and you're also looking at, hey, listen, the mortgage rate is close to, why wouldn't I just transition to a home and buy my home? And they're sort of building equity and looking towards that. So we're seeing a huge transition as it relates to that trade-off effect. And believe me, the renting prices are still going to keep going up. Therefore, it's going to push more consumer demand in the real estate market. Now, why do I talk about this? Because it's a huge part of the economy, and it's also part of what we do at Blanke, Schein Wealth Management, because we have a lot of clients that come to us, whether they're buying a home for their kid or a second home here, or just had a conversation with a client this morning who's looking to build a home in Idaho, and they want to know sort of financially where they sit, how we can customize, how we can sort of bridge loan that with a portfolio loan potentially, if that's right for them, or all of the above. So we want to be in the forefront. We put that calculus in the financial plan for our clients, and then we can make the proper advice, say what pocket you take it out of, how you fund it, and the timing of which really helps you save time and money and ultimately get that property that you want that could potentially be in a supply demand or even a bidding war sometimes. And why do I say that? Well, this is the National Association of Home Builders Index. And it went to the pre-pandemic high and all the way down to where we were to now a natural level of pre-COVID. And it's bounced higher. So we can see the index here move in terms of, like we said before, affordability came down, actually went up because of interest rates went up, or went down, last week or a few weeks back. But this is also interesting too. This is labor price or lumber prices. So lumber's gone up and it's come crashing down and it's turned the corner. So that's sort of inflationary built in, but it's down to the pre-pandemic sort of right where the market should be in terms of lumber. But it's turned the corner, it's bottomed. We don't know if it's temporary, but again, it comes down to ultimately it's a supply demand issue, and there's short supply on real estate. So if you see something, you like something, and you kind of want to wait for the extra 5, 10, 15, 20% of the downside to sort of jump on a real estate opportunity that might be right for you, you could be waiting quite some time. So our recommendation, our advice to our clients is, listen, there's always an opportunity. There's always a seller that has to sell for some reason, whether it's an estate sale, the kids don't want the house, mom and dad or grandma and grandpa just moved out, and they're now putting the house in the market. They're going to sell that house at a discount because they want the liquidity. Again, doesn't matter if it's an up market or a down market. If you've got the right real estate team on your side, there's always a great opportunity there. So that's our update right now. Close look at housing and real estate. It's always interesting because it's a huge component to the GDP, the growth of the U.S. economy. It also indicates the health of the consumer. Again, how corporations and how individual sort of companies sort of navigate through the consumer. And the consumer is at the head because 2/3 of the U.S. economy. But the consumer's hanging in there. Why? Because job markets are still strong. So that's sort of a global recap that we're looking at today of both short-term, long-term, and all assets in your balance sheet from stocks, bonds, even real estate. Thanks for watching, and we'll see you again next time.